One of the biggest news in the banking sector this week is the announcement that PacWest Bancorp, a regional lender based in California, has agreed to sell a large portion of its real estate construction loans to Kennedy Wilson Holdings, a global real estate investment firm. The deal involves 74 construction loans with a total outstanding balance of about $2.6 billion as of March 31. PacWest will also sell 6 additional construction loans with a balance of about $363 million to Kennedy Wilson. The transaction is expected to close in multiple tranches during the second and third quarter of. Why is PacWest selling these loans? According to the company, the sale will allow it to reduce its exposure to construction lending, which has been impacted by the COVID-19 pandemic and the resulting slowdown in economic activity. PacWest said that construction lending accounted for 36% of its total loan portfolio at the end of 2020, and that it wanted to lower that percentage to around 15% by selling these loans. PacWest will also free up capital and liquidity that it can use for other purposes, such as investing in higher-yielding loans, repurchasing its own shares, or paying dividends to its shareholders. PacWest expects to record a pre-tax gain of about $200 million from the sale, which will boost its earnings per share and return on equity. Who is buying these loans? Kennedy Wilson Holdings is a global real estate investment company that specializes in acquiring, developing, and managing properties across various sectors and markets. The company has over $20 billion worth of assets under management, including office buildings, multifamily apartments, hotels, retail centers, and industrial properties. Kennedy Wilson sees this deal as an opportunity to expand its portfolio of high-quality real estate assets in attractive markets such as California, Texas, Florida, and Hawaii. The company said that it expects to generate attractive returns from these loans, which have an average loan-to-value ratio of 56% and an average interest rate of 5.4%. Kennedy Wilson also said that it has sufficient capital and liquidity to fund the future draws on these loans, which amount to about $1.4 billion. What does this deal mean for you? If you are a customer of PacWest Bank or a borrower of one of these construction loans, you may not notice any significant changes as a result of this deal. PacWest said that it will continue to service these loans until they are paid off or transferred to Kennedy Wilson. The terms and conditions of these loans will remain unchanged. However, if you are an investor or a follower of the banking sector, you may want to pay attention to how this deal affects the performance and outlook of both PacWest and Kennedy Wilson. For PacWest, this deal will reduce its risk profile and improve its profitability and capital ratios. For Kennedy Wilson, this deal will increase its exposure to the real estate sector and diversify its sources of income. This deal also reflects the changing dynamics of the banking industry in the wake of the pandemic. As some banks seek to shed their non-core or underperforming assets, others may see opportunities to acquire them at attractive prices. This could lead to more consolidation and competition in the market. That's all for this section. In the next section, we will discuss how PacWest Bank plans to use the proceeds from this loan sale and what are its growth prospects for the future. What are the implications of the loan sale for PacWest and its customers? This is a crucial question that many investors and borrowers are asking after the bank announced that it would sell a $2.6 billion property loan portfolio to Kennedy Wilson Holdings, a multinational real estate company. The loan sale is part of PacWest's strategy to strengthen its balance sheet and focus on its core community banking business. The bank has been under pressure since Silicon Valley Bank collapsed in mid-March, prompting depositors to pull money from other mid-sized regional banks. PacWest's shares have lost 3/4 of their value since the start of the year, and its market cap of $44 billion in assets is below $1 billion. By selling the construction loans, PacWest will reduce its exposure to the volatile real estate market, especially in the West Coast, where property values have been falling. The bank will also improve its liquidity and capital ratios, which are important indicators of financial health and stability. According to PacWest CEO Paul Taylor, the loan sale will increase the bank's tangible common equity ratio by 1.5% and its liquidity coverage ratio by 10%. The loan sale will also affect PacWest's earnings and share price. The bank expects to record a pre-tax gain of $200 million from the transaction, which will boost its net income and earnings per share. However, the bank will also lose interest income from the loans, which have an average rate of 8.4%. The net impact of the loan sale on PacWest's profitability will depend on how the bank reinvests the proceeds and manages its expenses. The loan sale will also have implications for the borrowers and the projects that are financed by these loans. The portfolio includes 74 construction loans for residential and commercial properties across 14 states. Kennedy Wilson will assume the future funding obligations for these loans, which amount to $2.7 billion. This means that Kennedy Wilson will become the new lender for these projects and will have control over their terms and conditions. The borrowers may face some changes in their loan agreements, such as interest rates, fees, covenants, and deadlines. They may also have to deal with a different relationship manager and customer service team. Some borrowers may welcome the change, especially if Kennedy Wilson offers more flexibility and support for their projects. Others may prefer to stick with PacWest or refinance their loans with another lender. The loan sale may also affect the supply and demand of real estate in the markets where these projects are located. Kennedy Wilson is a global real estate investor that owns and operates properties in various sectors, such as office, retail, multifamily, industrial, hospitality, and residential. The company may have different plans and strategies for these projects than PacWest did. For example, Kennedy Wilson may decide to sell some of these properties or convert them to other uses. This could create opportunities or challenges for other developers, buyers, sellers, tenants, and brokers in these markets. Finally, the loan sale may signal PacWest's future plans and prospects. The bank has said that it is exploring other options to improve its performance and position, such as selling its $2.7 billion lender finance division or raising more capital. Some analysts have speculated that PacWest may be preparing itself for a merger or acquisition by another bank that can offer more scale and diversification. However, PacWest has not confirmed any such plans and has maintained that it is committed to serving its customers and communities. In conclusion, the loan sale by PacWest is a significant event that will have various implications for the bank and its customers. The loan sale will help PacWest improve its financial condition and focus on its core business. However, it will also affect its earnings potential and growth prospects. The loan sale will also impact the borrowers and the projects that are financed by these loans. They will have to deal with a new lender that may have different expectations and objectives for these projects. The loan sale may also indicate PacWest's future direction and destiny in the banking industry.